Hello everybody, and welcome to the next instalment of the Blackwell Global webinar series. This evening we're going to be talking about scalping strategies. We'll be covering how they work in markets, how useful they can be, and I'll also be providing you with a couple of scalping strategies to take away and test for yourself. But as always, let's begin with a quick risk disclaimer. Forex and CFDs are leveraged products and involve a high level of risk and can result in the loss of all your invested capital. Therefore, Forex and CFDs may not be suitable for all investors. You should not risk more than you are prepared to lose. Before deciding to trade, please ensure you understand the risks involved and take into account your level of experience. Seek independent advice if necessary. So what are we going to talk about in today's session? Well, we're going to focus on scalping strategies, but for those of you who are new to trading or who have a background that is purely private trading, what we're going to talk a little bit about to start with is provide some context through talking about the types of strategies that are used by what would be termed prop shops or proprietary trading houses or hedge funds. We'll talk a little bit about what scalping actually is. I'm going to provide you with two very simple scalping strategies that you can take away and mold to your own type of trading, and then we'll finish up with conclusion, and our account representatives here at Blackwell Global and myself will be very happy to answer any questions you have either about scalping strategies or about Blackwell Global in particular. So, I want to try and pitch this as a conversation that new traders may have heard certain terms or certain words, but may not really understand what that actually means. So when you hear a hedge fund or a prop shop talk about how they are a global macro or directional fund, what that normally means is that they are a trend following style trading house. If they talk about being directional or events driven, then normally what that means is that they're covering momentum. If they talk about relative value, that's normally an indication that they are involved in mean reversion trading strategies. And if they talk about relative value and event driven, well, that very often covers arbitrage, or very often you'll hear it called statistical arbitrage. Quite often the event-driven funds are pure scalping funds, and you're going to learn more about that as we go through today's session. And finally, if you hear a fund that is talking about event-driven or its relative value, that may be a fund that is involved in high-frequency trading. Now, for some of you, that might actually help unlock a vision or an idea of what particular funds are doing. But what we're going to do is just go through a few of those particular styles very, very quickly, before we talk about scalping in particular. So, a trend following. Well, we would expect that most private traders would understand what a trend following fund is all about. Not surprisingly, these strategies follow general trends in a set of data by comparing historical and current prices, profiting whether prices go up or down. Are trend following strategies suitable for private traders? Yes, most definitely. What we have here is just an example of a trend following strategy. It's a very simple chart here of, this is the US 100, the Nasdaq 100, and I would hope that you'd be able to see that, the Nasdaq 100 has been for the best part of this year and most of the last year or two in a fine uptrend. And so what you'd be finding is that trend following hedge funds and prop shops will be looking to be able to try and trade that in the terms of following the trend, either by trading a breakout to new highs or trading a pullback. You quite often hear on the sort of CNBC and Bloomberg, you will hear people talk about buy the dip, and that's what very often trend following traders are looking to do. Sometimes you'll hear traders talk about a mean reversion strategy. What does that actually mean to us as traders? Well, the philosophy behind mean reversion strategies is that instruments have an average price over time and they use historical data to compute an average price. Does that mean it's suitable for private traders? Yes, yes it is. What I have here is a simple chart of the Euro US dollar daily chart, and this is where you're using mean reversion, and we're basing our mean reversion around the 50 period moving average. So on this particular chart, hopefully you can see the red moving average. That's just a simple 50-day moving average. And as we said, mean reversion is about, price expecting to be reverting to fair value. And hopefully you can see even on this chart, once price starts to get extended, as you can see, extended to the north side where we have the sort of the blue ovals. When price gets overly extended, then it reverts to the mean. And what we're using is that 50 period moving average as an indication of what fair value is. Furthermore, on the opposite side, when price drops too far away from that 50 period moving average, as you can see from that sort of light purple ovals on the sort of the bottom end of the charts, well, what we get to see is price reverts back to the mean once again. Price extends away from the moving average, it then reverses and fires all the way back up to that moving average. So once you're able to understand this concept, then it provides some fantastic trading opportunities, especially when markets are in a range-bound environment. It suits mean reversion trading very, very well indeed. And it's entirely possible for a large hedge fund to be trading that, and also for a private trader, whether it be at a prop shop or at home, to also engage in similar trading strategies. Arbitrage. What does arbitrage mean? Well, arbitrage strategies depend upon the speed to catch price imbalances between different markets. Is that really suitable for private traders? The answer would be not really. As markets have evolved and developed, and as internet technologies have allowed instantaneous communication, the size and frequency of differences in price imbalances have changed considerably. In the old days, you might be able to sort of trade arbitrage where, let's say, for example, the New York price of gold might be different from the London price of gold. And as you trade towards the sort of average price, that presented you with an opportunity. But these days, those kind of opportunities are few and far between. Whilst there are very, very small arbitrage opportunities, they don't really suit the private trader. What you'll find is very often it's high-frequency funds or algo funds that are very often engaged in statistical arbitrage. So for private traders, it's good for us to be aware of it and to know what it is. But the reality is it's not really a suitable trading style for most private traders. Then we look at scalping. Scalping strategies act like market makers and make small profits on difference in the bid-ask spread. Does that mean they're suitable for private traders? Yes, absolutely, but with some caveats. And that's what we're going to talk about for the rest of our session today. Those particular caveats that enable private traders to operate scalping strategies in today's modern markets. What we have here is a recent chart of the US dollar yen. It's the 1 minute chart. And actually what we're seeing is how price reacts around certain particular levels of support and resistance, and also around a piece of data, a piece of news coming out. We can see that, even though it's a 1 minute chart, the great nature of fractal charts is that, this could be a 1 minute chart, but it could also be an hourly chart, a weekly chart, a monthly chart. But hopefully what you can see is that, the double 112.65 price was a suitable level of support and resistance, a very strong level at that particular time. And hopefully you can see where traders have actually scalped off that particular level running up to the news. Then once the news comes out, price fires north. It then puts in a head and shoulders reversal pattern, which then actually shows you as a mean reversion. price comes right back down to that particular level at 112.65, and you'll see scalpers actually just buying that particular level as it bounces off it, and we get a bounce for about just under 15 pips very, very quickly on the 1 minute chart. Price comes back down to that 112.65 zone, and once again price bounces off that and runs for another almost sort of 18 to 20 pips from that. So very good, very accomplished scalping traders are able to utilize the sort of the opportunities that arise within modern financial markets to be able to scalp around particular news events, scalp around particular levels or zones, and utilize that as a way to make very quick, fast profits. The last one of this type of strat is high frequency trading. And realistically, these are operating at the millisecond level or even faster. And these strategies use arbitrage or scalping techniques at high volumes and super fast speeds. Is that really a suitable style for private traders? The answer is no. It's not really. Okay, that is a enormously capital intensive way of trading, because invariably you need to have massive investment in the technological infrastructure to be able to operate at that level. And the reality is that for private traders trying to operate in that zone, it's really not the best way that we can employ our time, our resources, and our skills. So once again, it's good to be aware of it. It's good to know that these trading operators are out there, but it's about knowing, are they suitable for ourselves as traders, or realistically, are we sort of better focused on one or two particular areas that would provide us with the better opportunity to be successful. So, just to quickly recap, what can we use as private traders? Well, trend following is a very popular trading style with private traders, and is really available across all time frames. You will find people who will try and trade trends on 1 minute charts, and there'll be people who will try and trade trends on daily, weekly, monthly. Momentum trading styles are also very, very popular for private traders, and they are equally valid across all time frames. The same with mean reversion. Mean reversion is a very, very good trading strategy for range-bound markets. And finally, scalping. Scalping we are able to do on intraday time frames, so long as we have an understanding of how to do it effectively, and also we can trade that with with good discipline, that we can execute our plan superbly time after time after time. So let's take a little bit of a look at scalping in detail. So what actually is scalping? For some of you, you may be aware of it, some of you may have heard of it, some of you may have already engaged in it. But what we're going to talk about is scalping at its, let's say, its lowest level, and realistically scalping is the shortest time frame in trading. And when I say shortest time frame in trading, what I'm talking about there really is in terms of manual traders being able to sort of exercise within the market. Yes, HFTs will do elements of scalping, but they may be scalping for exceptionally small digits. Digits, not sort of really capable for ourselves to be able to sort of recognize rather than actually trade. Scalpers, which is the name given for people indulging in scalping, are looking to exploit small changes in the instrument's price, and it really can be very, very small changes. It might be just 1 or 2 pips, it might be half a cent, 1 cent, or in a particular equity, looking to exploit very, very small changes in the instrument's price. To be able to do that, it normally involves us being able to sort of take our position and also close our position very, very quickly, and we're usually talking minutes at a maximum. And very often it can be just seconds. So of course, to be able to operate at that level, you really need to understand what you're doing. You really need to understand the market itself. And you need to actually be able to operate with really good discipline in terms of your executing your trade plan. So if you're going to engage with scalping strategies in the market, there are a few points that I'd like you to note, a few points that I'd like you to take on board and build into your own scalping strategies. Remember, the profit is likely only to be for a few pips. So that might just be single digits in terms of number of pips. We're not looking for 100, 200, 300 pips here on a trade. This could literally be anywhere between sort of 2 and 10 pips on a scalp. With that in mind, it's very, very important that we only trade in liquid markets. So we're trading in markets where there is a great deal of volume coming in and out of that particular instrument. And invariably what normally has is that they also have a particularly tight spread. We also want there to be stable volatility. Yes, volatility can help us in terms of certain trading styles, but when it comes to scalping, we're actually looking for a little bit of stability in the volatility. We don't want to get spiked out left, right and centre because we're probably operating with very, very tight stop losses. So if we're only looking to trade in liquid markets with stable volatility, we usually conduct it where there is capital and leverage aplenty. So very often that will operate for most private traders in sort of trading either the FX markets or the indices markets. They tend to be very liquid, they tend to have tight spreads, they tend to be for the most part stable volatility, and there is the ability to use capital and leverage within those markets. And as for any particular trading style, risk management is key. When things are happening really fast, and they do for scalpers, it is crucial that you have a very tight rein on the risk management of your trading account. Things can happen very quickly, things can change very, very swiftly, and you need to be able to manage risk, manage your trades, and manage yourself, manage your emotions as well. One of the things that people underestimate is when things happen fast, our emotions get triggered fast as well. And that's not always a helpful thing when a market is moving fast. So, we've given you an introduction into the various types of trading styles that both prop shops and hedge funds use. We've had a quick look about which ones are suitable for us as private traders to use. We've given us a little bit of insight into scalping, what it entails in terms of engaging with the market. And now what I'm going to do, ladies and gentlemen, is talk you through a couple of very simple scalping strategies that you can use to effectively, build your trading business. So here's the first one, the big level trade, or what you'll hear me refer to as the BLT. It's a very simple scalping strategy around big figures, big levels. You'll find that hedge funds and market makers will utilize this every day. What it does is it combines event-driven opportunities and relative value styles. That should hopefully become more apparent as we talk through the trading setup. So, here's part one, the setup. How do we identify the setup? Well, as the name implies, we are looking for a big figure or a big level. So what we want to do is to look at the markets that we analyze on a daily basis and look at the ones that are trending towards a key psychological level. If you want to know what a key psychological level is, well, either it should be drawn on your chart already as an existing level of support or resistance, or as an idea it can be either a 00 or a 000 number. So what we'd be looking at in, let's say in the euro dollar, was 120. So what we had there was, a big round psychological number that was of interest to all of the traders. In the pound against the dollar, we've recently had 130, okay, 13000. That becomes a key psychological level. Why is that important? The reality is humans are lazy. Humans are lazy. And what we will do is we will focus, we have biases that allow us to focus on particular key psychological levels. So what you'll hear is traders talk about, instead of actually identifying the precise level that they will get in, they might say, well, I want to buy pound dollar at 120 and then I want to sell out at a profit at 130. We just use simple big figures. It's an element of laziness in human beings. We all do it. We all do it in all aspects of our life. But this actually also provides us with a trading opportunity. How does it provide us with a trading opportunity? Well, because that's where those big levels, those big psychological numbers, are where traders will have either their entry orders or their stop loss orders. And market makers, dealers and hedge funds, they know where those orders are sitting. One of the things I need to sort of get you to understand is that market makers and dealers, they only get paid when orders are triggered. So it is in their interest to bully price towards where those biggest blocks of orders are sat. Where do you think those biggest blocks of orders are sat? They are sat around key psychological levels, big figures. So they know that if price moves towards those levels, there is a higher probability of reaction, and that provides an opportunity. And by learning and understanding this provides you, the private trader, an opportunity for you to trade like a hedge fund and scalp away in markets. So here's a good example. This is the pound against dollar, and it's seeing how we price reacts around the 1-3-0-0 number. Remember what I was saying? We like to see particular levels with either 00 or a 000. This is 130. Okay, this has been a very key level. And what we can see here is that, this is the 5-minute chart, but what we can see is price pushes up to the 130 level, falls away. Every time it pushes up, even if it just goes up a little bit above it, it rolls over and falls away. And actually price tries to attack that level on that day, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, at least 10 times that day. Price actually tries to attack that key psychological 130 level. But if you have a look at the actual price action, the chart, you'll see that the furthest it gets beyond that 130 level is around about 130.13. 130.13. 13 pips beyond the number before price is knocked back and flattened away. And this is what we're talking about. Price will get bullied up towards that level because the dealers know there are orders there. And very often there will be a reaction. Price will very often bounce away from it. It will fade away from that particular level depending upon the direction that it's attacked it from. And that provides you with a very quick scalping opportunity to trade that particular market. Here's an example of the Euro US dollar, and this is the big level trades around, once again, big psychological number, in this case the 1-2000, the 120 level. You can see the strong red line is the 120 level, and hopefully you can see this is on the 5-minute chart to show throughout the day. But this was the first time that earlier this year that price started to attack the 120 level, and hopefully you can see the very first time it goes up, it gets knocked straight back down. Tries to go up again, gets no more than around about sort of 120.06, no more than about 6 pips past the 20 level before it gets double tops and gets knocked away. It tries to force itself up there again, and price action gives us a really nice big key reversal bar, engulfing bar, pin bar at that level, lower high before price drops away down violently again. And then actually it sits and takes a good few hours, price actually just bubbling away underneath the 120 level, before at the end of the day there is another assault on the 120 level, and actually once again what you can see is it gets no more than sort of 6-7 pips beyond 120 before it is knocked back again. So hopefully you can see, just looking at those two last charts, that these particular levels, they become significant. Some of you may have looked at these charts and already start to think, well, actually, I can see where there are opportunities for me to sort of trade around those particular big levels. And that starts to become an interesting phenomenon that we can utilize day to day across all manner of time frames to build ourselves our own scalping strategy. So, here's part 2. Set your orders. What we want you to do is, for a sell where prices come up from beneath, we want you to sell element 1, trade 1 at the figure. So as in that previous chart, that would have us one contract to sell at 120. The next part of the trade would be to sell element 2, which would be 2 contracts at 5 pips over the figure. So in that particular previous euro-dollar example, you'd then have sell 2 contracts at 120.05, and that would be your trade. The final element would be sell element 3 at 10 pips over the figure. So that would have 3 contracts at 10 pips over the number. In the last euro-dollar example, that would you having 3 contracts at 120.10. The stops for all elements are set at 20 over the figure, and you have a profit target for 2/3 of the trade at 5 pips below the level. Now, some people who have traded this for a while would look at that and be rather find that a rather aggressive trading strategy. But then, this is scalping. Scalping by its very nature is a rather aggressive trading strategy. And so maybe, the way we trade as a scalper has to be different from the way we trade as a trend following trader, or as a momentum trader, or as a mean reversion trader. This is quick, it's sharp, it's hard, and it's aggressive. And that's what we're looking to do. We're looking to get in, to make a few pips over a few seconds to a minute, and be done. We're not looking to hang around. So, once again, as I said, here's this chart here. Hopefully, as you said, we discussed earlier, you can see that it's a 120 level is the sell level. But actually, you can see that, every time you'd have sort of sold one contract at the 20 level with your stop at 20, every time you've hit here, you'd have actually made your 5 pips of profit. Furthermore, that, on 1, 2, 3 occasions, it actually sort of price meandered its way up to the 120.05, where we'd have our next 5, we'd have 2 contracts at 120.05, and once again, you can see that those trades would have been triggered and actually would have hit their targets. At no time during this particular day did price get anywhere near its stop losses of what would have been 120.20. So this day, the first day of attack of 120, would have been a very, very handsomely profitable day. So what are the keys to this particular trade? Well, not surprisingly, when you're going to be scalping, you need to be prepared ahead of time, and you need to stay vigilant. You need to be sort of, a very keen watcher of the markets. Once the trade has been triggered, if the trade does not work out immediately, so that's a maximum of 15 minutes, then close out the trade. Why would we do that? Because remember, this is scalping. We expect markets to move hard and fast and aggressively. And if they are not, it's because something has changed. Something is not happening as we want it to. And the best thing we can do is to get out. Although these moves are similar near most big round numbers, this trade also works best when at the end of let's say an overbought or oversold intraday trending move, and when we couple it with strong psychological numbers. So, we just showed you there, we showed you the euro dollar at 120, and we showed you the pound dollar at 130. Big, strong psychological numbers. And if you have some trading experience, well, then you might look at big level trades at the previous day's highs and lows on big news days. That's something that you can take away and research and have a little bit of a play with in your own time. The final few points for the BLT. Remember, we aren't trying to predict the future. We're just riding the sort of hedge funds and market makers' coattails. We're not looking to be a hero. We're not looking to make hundreds of pips. This is it. We're in it for a quick few pips. A scalp. That's what it is. A scalp. Quick few pips. We're in. We're out. We're done. No messing around. What I'd also like to suggest is that you take no more than 2 attempts in any one trading session. So the first time price hits, let's say, 120, we have a trade on. The second time price hits 120, we have a trade on. The third, fourth, fifth, sixth time, we don't. Why is that? Well, because, we don't want to really push our luck. If we've had our 2 first trades of the day and they've worked nicely, we can be grateful for that, and then we can move on. The longer that price keeps hitting that level, the likelihood is that either the bulls will overwhelm the bears, or there will be a change now in the sentiments going forward, and then actually price will take off. So let's not be greedy. 2 opportunities on a good day like that, and that's us done. So I hope you found that interesting. I hope you found that useful. What I would suggest is just go away and open random charts, doesn't really matter what they are, and just see how the price on that chart reacts around those big levels. Does price race up to it, turn around and fall away? And if so, does that present you with an opportunity to take a few cheeky pips from the market? Now we're going to talk about another trading strategy for you, which is a little bit different, but the whole idea is they are to be complementary. And this is what we call the double BB close. What are the keys to the double BB close? Well, the double BB close is all about identifying momentary periods when the market is overextended and the likelihood for a reversion to the mean may occur. Remember, we talked about mean reversion earlier on in the session. We showed you a little chart there where how price becomes overextended away from a particular moving average or a particular indication of fair value, but then we expect price to reverse and actually revert to the mean. Like all scalping strategies, it requires good working knowledge of the strategy and the particular instrument that it is going to be traded on, because we must be ready to act without hesitation when the trade setup appears. As I've said a few times during this particular webinar, in terms of being able to scalp effectively and profitably, it is required that we know how our strategy works and we're in a position to be ready to act without hesitation when the trade setup appears. So here's the double BB close setup. How do we have our chart set up? Very simply, just our normal 20, 50, 200 simple moving averages. But now we also have Bollinger Bands. Furthermore, we have a little bit of a different deviation on our Bollinger Bands. Normal Bollinger Bands have a deviation of 2. What we need to do is to actually set the deviation to 2.5. What it just means is the Bollinger Bands are a little bit wider. Remember, what we're looking to do is to show that overextension to give us an idea of when price might snap back. We can use fractals, although it's not particularly important for this total strategy. And we're looking to just trade this on the 1 and 5 minute charts on the MetaTrader platform. You'll find that the Blackwell Global MetaTrader platform has all of these indicators. Certainly has very simple moving averages. It has Bollinger Bands on there, and you can also effectively, change the deviation by which you set them. You'll have fractals, and you can also choose between the 1 and the 5 minute charts. For those of you who have never even heard of Bollinger Bands, well, what we have here is a chart. We can see the black and white candles just doing their thing, and hopefully you'll be able to see we have a 20 period moving average going down the middle. And then what we have is that we have the kind of almost like a balloon on the either side of it. Those are the Bollinger Bands. If you Google Bollinger Bands, you'll see plenty of trading literature upon them. That you could spend your entire weekend reading about them. But for today, all I need you to know is to have them on your charts, and I'm going to show you how we use them to scalp markets with a mean reversion style. So here's the first part of the setup. On the 1 or the 5 minute chart, wait until you see 2 consecutive closes outside of the Bollinger Bands. That's 2 consecutive closes. So that's, literally 2 candles back to back closing outside of the Bollinger Bands. Why are we interested in that? Because when that happens, it's a sign that price really has become overextended from that 20 period moving average. That is the first sign we look for. That's the first sign we're interested in, and that's what we're looking for as the setup for our trade. Number 2, once you have a double close outside the Bollinger Band, we have a valid setup. So, 2 closes above the Bollinger Band and we are looking for a mean reversion short trade. 2 closes beneath or below the Bollinger Band and we are looking for a mean reversion long trade. On this particular example here, hopefully you can see, we actually we've had a few closes outside of the Bollinger Band. But in this particular, we're looking at this one. Here's the first one that closes outside, and then the second candle closes outside as well. So we've got 2 closes. For a short setup, what we're looking for is 2 consecutive closes above the Bollinger Bands. Hopefully you can see that there. We have the first candle here that closes above the Bollinger Band, and then so does the second one. We also have the nice confluence of price actually running into the green, which is the 200 period moving average. For a short trade, well, we then place, once we have those 2 candles, we place an order to sell the break of the low of the second candle, and what we're looking to do is normally sort of trade about 1 pip beneath the low of candle 2. Our stop loss goes above the high of the 2 bars, normally 1 pip plus the spread when we're shorting. So we identify the 2 candles that are closing outside the Bollinger Band. We then look to sell the break of the low of the second candle, and our stop loss goes above the highs. Once the trade is on, the basic target, which is all we're going to cover for this particular webinar session, is the middle of the Bollinger Bands, which is the 20 period moving average. So we're looking to get in at the break of the low of candle 2, and our target is actually the blue 20 period moving average. You can set that target, but what you should also be prepared to do is to adjust that target based on any changes within the 20 period moving average. Remember, as every candle is plotted, the Bollinger Band and the 20 period moving average will be replotted as well, and so you may need to adjust it on occasion. A long setup is the exact opposite in return, where we'd look for 2 candles to close beneath the Bollinger Bands. We'd then look to buy the break of the high of candle 2. Our stop loss would go beneath the low of the 2 candles, and then our target would be the 20 period moving average. Here's a few final rules. Where possible, we want to set pending orders for our trades, but I admit that sometimes, especially on sort of short time frames, that may not always be possible, and we may need to enter at market, and that's okay. Once again, if the trade is not triggered within 3 periods, then remove the trade. We're expecting price to overextend and then snap back towards the middle. If it isn't doing that, or if it's continuing north, well then the price isn't ready to snap back and we no longer want to be in that particular trade. If the trade does not particularly fire up that during that period, but then sets up again, so that we have a new candle that provides us a new 1-2 close outside, we'll then just reset the trade but on the new data. So, what have we talked about today? Well, we've talked about the types of strategies used by prop shops and hedge funds, and we've talked about whether they are particularly relevant or open towards private traders. So things like trend following, momentum, things like scalping, we decided, and mean reversion, we decided were all very, very plausible as trading styles for private traders. In particular today, what we've talked about is scalping, and how scalping is the shortest time frame for ourselves as manual traders. And it's where we're looking to exploit small changes in the instrument's price that give us that opportunity to take a few pips out of the market. It normally involves us establishing and liquidating a position very, very quickly in the markets, and that can usually be a position for either a few minutes or a few seconds. We talked about 2 particular scalping strategies you can take away. The BLT, the big level trade, or the double BB close. The big level trade requires vigilance to know where your instrument is in regards to those big psychological numbers, those big 00 and 000 numbers. We talked about how, the price attacks those levels. It very often gets faded away, and that is our opportunity. But we should take no more than 2 trades in any one session based upon those assaults on that particular level. And the double BB close is about A, where price has become overextended on a very, very short time frame, and we are looking for a snapback towards the 20 period moving average. And that is what sets us up as a mean reversion trade and provides us an opportunity to scalp a few pips out of that market as price works its way throughout the day. So I hope you found that useful, ladies and gentlemen. I hope that's given you a good insight into some particular scalping strategies that you may wish to use. I wish you the very best of success in your own trading. I hope that those 2 scalping strategies will give you some great food for thought and some opportunity to take and build upon them and mold them into your own particular scalping strategies. I'll happily take any questions you have either today or after a few days when you've had a chance to either watch this or for the education to sink in. You'll find that myself or the account representatives at Blackwell Global will be very, very happy to answer your questions and also to help show you where those particular levels are on your MT4 Blackwell Global MetaTrader. Thank you very much for joining us for this webinar, and I look forward to speaking to you in the future. Trade well, and many thanks.